The ledger never lies. In the forensic history of empires, there is a specific ledger that officials stopped reading to the public the moment the mathematics turned terminal. We call it the 1951 Ghost Ledger. For 75 years, it sat in the deep shadows of the Federal Reserve's official record, a silent, dust-covered confession of a struggle that the architects of the modern dollar thought they had won. In the spring of 2026, the vault door has finally been forced open, and the archive has just accepted its final, irreversible entry. What the record proves is not a temporary market fluctuation or a soft landing that failed to materialize. It is a structural verdict on the American experiment. As the U.S. Treasury faces a zero-bid auction environment and a staggering $39 trillion debt wall, the Ghost Ledger reveals a truth that no politician can admit on a Sunday morning talk show. The Federal Reserve is no longer an independent auditor of the empire. It is its most desperate survivor. To understand the insolvency of 2026, we must first audit the event that supposedly gave us sound money, the 1951 Fed-Treasury Accord. Historians call it the moment of the Great Refusal. For years during and after the Second World War, the Federal Reserve was essentially a captive of the Treasury Department, forced to peg interest rates at artificially low levels, 0.375% for bills, just to finance the massive war debt. The Fed, in those years, was not a central bank. It was a printing press with a sovereign leash. But in March 1951, the Fed fought back. Led by Mariner Eccles and Thomas McCabe, the Fed refused to continue the peg, regaining its independence to fight the inflation of the Korean War. It was hailed as a victory for institutional integrity. But the Ghost Ledger records what the standard history books omit. The independence of 1951 was only possible because the empire was young and the math was in its favor. In 1951, the U.S. debt-to-GDP ratio was falling and the demographics were fertile. The tax base was expanding and the maturity wall was decades away. Today, in April of 2026, that 1951 independence has become a forensic ghost. With a $39 trillion maturity wall and a zero-bid reality, the Fed cannot fight back as it did 75 years ago because there is no solvent buyer left to take its place. The demographics of the West have finally declared the social tontine insolvent. The archive proves a chilling reality. The independence of the Federal Reserve was never a permanent law of nature. It was a temporary luxury of a solvent empire. And in the spring of 2026, that luxury has just expired. In the forensic audit of 2026, we encounter a physical barrier that no amount of rhetoric or forward guidance can dissolve. The maturity wall. This is the structural reality of the debt cycle, where the past finally catches up to the present. As of March, the United States carries a national debt of $39 trillion. But the number alone, as staggering as it is not the autopsy. The autopsy is the timing of the repayment. In 2026, nearly one-third of that entire debt pile, roughly $13 trillion, must be refinanced. This is what we call the rollover risk. These obligations, many of which were issued in an era of near zero interest, must now be rolled over at market rates that the empire's current budget simply cannot sustain. In the 1951 era, the maturity of debt was spread out over decades. Today, the sovereign has shorted its own survival by moving to the short end of the curve. The Ghost Ledger records that when an empire loses the ability to term out its debt, it enters a terminal phase where every week is a potential default. The wall is no longer in the distance. It is the ground we are standing on. This brings us to what the archive calls the fiscal death lottery. This is the point of no return, where the cost of servicing the debt consumes the vital organs of the state. To pay the interest alone, before a single dollar of the principal is even returned to the creditors, now costs the American government more than its entire defense budget, every year. The 1951 archive reminds us that a central bank can only maintain the illusion of independence when it isn't the sole buyer of its own sovereign's survival. In 1951, the Fed could refuse the Treasury because there were other buyers, pension funds, insurance companies, and a domestic public with high savings. Today, in the zero-bid environment of 2026, those buyers have vanished. When the sovereign wealth funds of the Gulf and the central banks of the East stop recycling their surpluses into American paper, the Fed faces a choice it cannot survive. It must either allow interest rates to skyrocket, which would obliterate the domestic economy, or it must monetize the debt itself, which would obliterate the global standing of the currency. The Ghost Ledger proves that in 2026, the Federal Reserve is already doing both, hidden behind the veil of shadow liquidity. This is the desperate plumbing of an institution that is, by its own archival standards, insolvent. The primary dealers, the large banks tasked with facilitating treasury auctions, are holding toxic paper they cannot sell. The archive shows that when these dealers fail to move the debt, the Fed's mandate shifts from monitoring the economy to maintaining the life support of the Treasury. The Fed is no longer the lender of last resort that rescues the system during a panic. It has become the buyer of only resort that is the system. When the dealer of last resort becomes the only dealer, the market has ceased to exist. What remains is a command economy dressed in the tattered robes of a free market. The 1951 archive warned us that a central bank that loses its buyers loses its soul. In 2026, the Fed is a ghost, haunting its own ledger. To truly understand the insolvency of the Federal Reserve, a forensic auditor must look beyond the physical borders of the empire. We must audit the Eurodollar Fracture, the disintegration of the shadow banking system that has, for 70 years, acted as the world's actual reserve currency. This is a $13 trillion ecosystem of dollars created, lent, settled, and recycled entirely outside the jurisdiction of the United States Treasury and the Federal Reserve. It is the invisible plumbing of industrial civilization, a vast network of offshore ledgers that has fueled global trade since the mid-20th century. In the shadow world, a dollar is not a piece of paper. It is a ledger entry in London, Singapore, or the Cayman Islands. But in the spring of 2026, this vital plumbing has not just leaked, it has shattered. The Ghost Ledger records a phenomenon that economists and central bankers dread above all others: the sudden stop. Forensic note: a sudden stop is the moment when the rhythmic flow of international credit physically ceases. In March 2026, cross-border lending did not merely slow down under the weight of high interest rates, it physically snapped. The 1951 archive provided a chilling warning that we are only now hearing clearly. An empire's currency can only survive as long as its shadow system can find collateral to back its promises. In the Eurodollar market, that collateral was almost always American Treasury bills. But as of March 2026, the world has run out of collateral it can trust. When the underlying asset, the Treasury bill, is perceived as a fiscal death lottery or a zero-bid instrument, the shadow system that uses it for fuel stops moving. This leads us to the Basel Confession. These are the internal, highly sensitive records from the Bank for International Settlements, BIS, that were never intended to face a public audit. These documents, now surfacing in the forensic record, show that by mid-March 2026, the primary dealers in the Eurodollar market had reached what the BIS calls a terminal leverage point. The Basel Confession admits a truth that the Federal Reserve cannot speak aloud. The offshore dollar system is no longer self-correcting. The sudden stop was not a policy choice made by central bankers. It was a physical limitation of a mathematical system that had reached its breaking point. By March 2026, the global financial system had produced 40 paper claims for every single physical ounce of deliverable value. As the metabolic shock of $200 oil rippled through the economy, the world stopped asking for more paper. It started asking for delivery. And when the world asked for delivery, the loop finally broke. The loop, the recycling of petrodollars and trade surpluses back into American paper, was the heart of the system. The Federal Reserve in 2026 is no longer just fighting inflation or managing employment. It is attempting something far more desperate. It is trying to use the tools of a 1951 world to restart a heart that has already stopped beating. The Ghost Ledger tells us that you cannot revive a heart with the same paper promises that caused the cardiac arrest in the first place. The final entry in the 1951 Ghost Ledger is the one the sovereign feared most: the Gold Repatriation Panic. In the spring of 2026, the scramble for physical metal is no longer a fringe retail trend. It has become a core sovereign survival strategy for nations watching the sudden stop of the Eurodollar markets. The declassified Basel Confession, our archival forensic of the internal GHOS and GHOS-SIB reviews, admits what public press releases omit. As of March 9, 2026, the global systemically important banks, GSIBs, have reached a point of terminal leverage. While the World Gold Council forecasts that central banks will purchase roughly 850 tons of gold in 2026, following the momentum of a multi-year buying spree from China, Kazakhstan, and Poland, the true story is not just the buying, it is the repatriation. Nations are no longer content to leave their gold in the vaults of the Federal Reserve or the Bank of England. They are calling it home, physically moving tons of bullion across oceans to secure it against the maturity wall of the West. The 1951 archive warned that when trust in custodial storage evaporates, the empire's ability to manage its debt evaporates with it. By early 2026, gold skyrocketed to record peaks of nearly $5,600 an ounce before experiencing a sharp correction in March. Despite this volatility, Goldman Sachs remains steadfast in its forecast. Gold is on a path to touch $5,400 by the end of 2026. This projection is not based on market sentiment alone. It is rooted in the metabolic shock of elevated energy prices and the intensifying conflict in the Middle East, which has forced a structural de-dollarization across the global south. When the world stopped trusting the paper promises of the Federal Reserve, they started weighing the metal. In 2026, the $1.0 trillion interest bill on the U.S. national debt has begun to consume 19% of all federal revenue collections, meaning for every dollar of tax collected, nearly 20 cents is vanishing into the service of the past. The archive proves that this is the point where the independence of a central bank becomes a mathematical impossibility. The forensic conclusion is not a prediction. A forensic auditor simply reads what the ledger records, that the Federal Reserve is now insolvent because its independence was a luxury of a solvent era, an era that finally ended at the $39 trillion wall. The history of 1933 reminds us that when a system fractures, the public reaches for the hardest asset available. And when the public reaches for the asset, the sovereign reaches for the public. The 1951 Ghost Ledger is now closed. It records a 75-year cycle of managed truth that has reached its terminal entry. But the sequence it recorded is still running in the streets, in the vaults, and in the zero-bid auctions of April 2026. Unlike the paper in the vaults, the ledger has never once been wrong.